Hello and welcome to the Business Standard Morning Show. I'm Ishan Gera and here are the stories for the day. Mukesh Ambani appears all set to join the ranks of super rich who have family offices in Singapore. The Asia's top and world's third biggest financial center will give wings to Ambani's ambitions and help him widen his overseas investment options. So, in today's episode, we try to explore the likely reasons behind this widely reported move.
For once, Mukesh Ambani is not a disruptor. He is walking the beaten path. The Reliance Industries chairman, who is also the second wealthiest man in Asia, is reportedly setting up a branch of his family office offshore in Singapore. Ambani, whose wealth was recently pegged at $86.6 billion by Forbes, is said to already have a family office running in Mumbai. Most of the top Indian business families and startup founders also have family offices abroad. According to a report, the majority of the Ambani family's investments were into Reliance Industries or RIL. Their part stake deals and acquisitions were also routed through RIL. So, the Singapore office will most likely focus more on global asset classes, which are increasingly becoming popular with the next generation of India's wealthy as they look to diversify their investments. According to auditors and wealth managers, a large number of wealthy Indians are setting up family offices in overseas jurisdictions like Singapore and Dubai to de-risk their portfolio from currency and geographical risks. Tax planning for the next generation, lower capital gains tax, and greater ease of doing business overseas are also important factors driving the rush to foreign locales. Mukesh Ambani is also said to have selected a manager who will recruit staff and get the new Singapore-based entity running. Office Space 2 has been selected and it is expected to be operational in about a year. Let us also have a brief look at family offices. They are of two types. First is the single family office, which is a private wealth management advisory firm set up by ultra-high net worth individuals. It only serves their family's investment and financial needs. Ambanis have opted for this type. Their primary investment function is wealth preservation and creation. And then there are multi-family offices for those who may not require a full-fledged single-family entity. They provide all the required services, but the family doesn't have to set up its own firm. India reportedly has an estimated 300 family offices, with an average asset under management of $100 million each. Some even have multi-billion corpuses. Gautam Adani, Ratan Tata, Pawan Munjal, Azim Premji, N.R. Narayana Murthy, and the Mariwala family all have family offices. India's media and sports celebrities and tech entrepreneurs have also jumped on the bandwagon. The list includes Yuvraj Singh, Priyanka Chopra Jonas, Akshay Kumar, Madhuri Dixit Nene, Sachin Tendulkar, Ritesh Agarwal, Kunal Bahal, Vijay S. Sharma, Sachin Bansal, and Rajul Garg, among others. Coming back to Mukesh Ambani, the location selected by him for expanding his family office is not much of a surprise. According to a report by law firm Raja & Tan Singapore and Deloitte, Singapore has emerged as the preferred choice for family offices in Asia due to its position as an international financial hub, which has a strong regulatory framework, stable and pro-business policies, tax incentive schemes, and well-developed infrastructure. The Monetary Authority of Singapore estimates that 700 family offices were located in the city-state by the end of 2021, up from 400 a year earlier. Singapore's competitive tax regime is particularly attractive. Its corporate tax rate is currently 17%. Meanwhile, India charges a corporate tax rate of 30%, with a reduced rate of 25% for companies with up to 400 crore rupees in gross turnover. Singapore also has a quasi-territorial tax system, which allows tax exemptions for select foreign-sourced income like branch profits, service income, and dividends. It also does not impose capital gains tax or withholding tax on dividends. Last but not least, the city-state has double taxation avoidance agreements with about 100 countries, including India.
These entities or structures are for increasing the portfolio of foreign assets and investments, right? Why Singapore? There is an operational efficiency part, or a regulatory environment and operational efficiency part, and then the second is the tax part. Because the moment you say Singapore, tax takes the precedence. Now, Singapore has been a financial services hub for the longest time. It's got a world-class infrastructure, professional help, for example, or a banking help that is available in Singapore is par excellence, right? Singapore also has got some unique regulatory or legal framework, such as the bilateral investment agreement that it has with India, right? It provides certain very, very key protections for investments between India and Singapore. The investor regime is so mature that there is something called a CAC, the Arbitration Council, that is there in Singapore, and it's very, very reliable.
This is also an opportune time for Ambani's move. Vishwas Panjiar, a partner at Nanjia Anderson LLP, explains that the Reserve Bank of India's overseas investment regulations, notified on the 22nd of August, will facilitate overseas investments by family offices. The erstwhile ODI regulations made it difficult for family offices to set up holding companies or fund structures overseas, as they required such entities to be necessarily approved by a regulatory authority in the host country. The problem was that most developed economies did not regulate such entities. But under the new regulations, an approval will be necessary only if it is required under the host country's laws. They also allow an Indian entity which is not engaged in financial services to make overseas direct investments in an entity that is engaged in such activities, except banking and insurance. As a consequence, a family office should now also be able to set up a fund overseas through its operating entity. According to multiple reports, more and more Indian family offices are looking to shift or expand overseas. Experts say that bigger family offices are being set up in Singapore, Dubai, and London. The recent regulatory changes could supercharge this trend.
I know for a fact that a lot of Indian families were waiting for the change that happened on I think 22nd of August in the new ODI regulations for setting up those family offices.
Wealthy Indians seeking to expand their foreign investment options, especially through overseas family offices, is par for the course. But, in a sense, it is still a commentary on the remaining gaps in the ease of doing business and regulatory environment in India, which lead them to select foreign jurisdictions. How quickly India can plug these gaps will have an impact beyond just family offices and will play a key role in lifting its economic performance.
Tip of the global wealth pyramid became a bit more crowded last year as the world grappled with the pandemic. The number of global ultra-high net worth individuals rose by 46,000 to a record 218,200. Meanwhile, in India, as the memories of horror perpetrated by COVID-19 started to diminish, a news shocked everyone. Over 100 million doses of COVID-19 vaccines expired last month. What led to this wastage? Let us find out in our next segment.
Somewhere in May last year, when the second wave of pandemic was in full swing, India was struggling to vaccinate its people. The government and the vaccine makers were trading charges while COVID-19 was taking a heavy toll on human lives. India, which was home to the world's largest producer of COVID-19 vaccine, failed to inoculate the entire population during the course of that lethal wave. But a few months on, by the month of July, India became the only country after China to administer over 2 billion COVID vaccination doses. The vaccination drive on scale was hailed as one of the best in the world. So far, over 98% of adults have received at least one dose of the COVID vaccine, while 90% have been fully vaccinated. Nearly 22.7 million doses are available with states as of October 1. And just about 15 months later, by the end of September, over 100 million doses of vaccines ended up being wasted as their shelf life expired. Were there no takers of these booster doses, or they simply didn't reach the needy? The loss, pegged at 2,250 crore rupees, fades in front of the loss it may have cost to people's health as the world is still facing acute vaccine inequality. The shelf life of Covishield is currently 9 months, while that of Covaxin is 12 months. The shelf lives of both the vaccines were extended by 3 months last year. Non-COVID vaccines typically have a shelf life of 3 years. As the pandemic waned, people became complacent. Masks disappeared from public places, and there were few takers for booster doses. Over 84% of India's population is eligible for booster dose, but only 27% of them have received the shot. The booster coverage improved thanks to a 75-day free booster dose campaign by the centre. In mid-July, the booster dose coverage was at meager 8%. Despite the gains, India still has a long way to go in improving booster coverage. Had it not been the free booster dose campaign, the wastage would have been higher. In an interaction with Business Standard earlier, Adar Poonawala indicated that he was trying to save around 50 to 100 million doses of vaccines in a free booster dose drive. Some amount of vaccine wastage is inevitable with such a large vaccination drive. However, governments try to minimize the damage. For all vaccines, GAVI recommends countries to keep the maximum wastage of 25% for the first year, with gradual reduction to 15% by the third year. For COVID vaccines, GAVI assumed the wastage rate could be 10%. If we look at the global scenario, the number of COVID-19 vaccines which are likely to have been wasted since the global rollout began is estimated to be 1.1 billion as of mid-July, according to data analytics firm Airfinity. The other major reason why so many doses ended up being wasted in India was because of misanticipation of demand. Experts say companies were unclear about the purchase orders from the center and ramped up capacity in a big way. Serum had accumulated 250 million doses of formulated vaccines and another 250 million in the bulk form by December last year and stopped Covishield production. Bharat Biotech too had a stock of 50 million doses lying at its plants around April and had halted production of Covaxin. The restrictions on exports did not help either. As India grappled with a deadly second wave in April last year, the government halted vaccine exports and resumed only towards the later end of the year. The restrictions meant that vaccine makers might have missed out on some of the export orders. Professor Y.K. Gupta, member of the National Expert Group on Vaccine Administration for COVID-19, tells more.
As on date, the vaccine which has been given in India is nearly 218 crore vaccination, which is perhaps the largest number of vaccines which has been given across the world. And if you just see, even if 100 million, 100 million means 10 crore vials have expired, I would say this should not be a panic. The reason are this is an unpredictable COVID situation. It's not like other diseases where there's more predictability. I would say that this is not a very happy situation that there's so much of vaccine go waste, but this is not a very alarmingly unusual situation. I would not consider this as a lack of policy planning, but I would consider that this is an inherent unpredictability in COVID-19 type of in the epidemic and the 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 situation, changing situation, and day by day, and the export potential also depends on how fast changing scenario is. So I would not say that there could be better administrative or better planning, which could have avoided completely such type of uncertain situation.
Even though some wastage was inevitable in such a large vaccination drive, the scale could have been minimized through proper planning. But it is easier said than done given the unpredictability of the pandemic.
Pandemic accelerated the demand for digital transformation, giving a booster shot to the Indian IT sector. The second quarter earnings season is set to begin today with results from IT major TCS. With IT stocks having succumbed to fears of a global slowdown this year, here's a report on what experts are anticipating from top Indian IT majors in the September quarter.
IT major Tata Consultancy Services will kick off the September quarter earnings season today. Wipro and HCL Tech will announce their numbers on October 12, followed by Infosys on October 13. Despite lingering fears of a recession in the West, analysts expect the IT pack to report decent revenues this quarter, supported by firm digital spending and deal wins. They expect margin pressures to continue in Q2 due to wage hikes and back-to-office costs. Attrition rate, on the other hand, should start to come down as the macro environment gets impacted. More importantly, analysts expect total contract value or TCV would be softer as no large deals have been signed during the quarter.
We are expecting that IT would perform better despite there being a concern in US regarding slowdown and also other macroeconomic challenges. So in terms of revenue, we are expecting that large cap would post around 2 to 5% quarter-on-quarter revenue growth in constant currency, while mid-cap companies would post around 3 to 6% revenue growth quarter-on-quarter in constant currency. And this growth will be largely led by ramp up of their deal in the previous quarter as well as their new deals won in this quarter. Now talking about margins, yes, margin have corrected around 300 to 400 basis points from pre-COVID levels. And this quarter, we are expecting margins to be around flat to say downside of 50 to 80 basis points due to expense like on-site and wage hike that some company have taken. However, we are seeing that there is limited scope for downside. And beyond Q3, we are expecting margins to improve.
Sharing similar views, Omkar Tangsale, Senior Research Analyst at Axis Securities, believes that IT spends and demand for digital initiatives have been resilient in the recent quarters.
The IT spending from these North America and European regions likely to remain resilient for this quarter at least, owing to the demand for the digital transformation and cloud transformation, which we believe likely to remain intact at least for the quarter. We do not see any spend cuts on this quarter for the large clients and also from the various geographies like European and US region. We expect margins likely to remain under pressure, which will likely to be offset because of the attrition level moderating and some comfort from the dollar appreciation and rupee depreciation.
From large companies, Kotak Institutional Equities expects Infosys to be the lead winner with a 4.7% sequential revenue growth in CC terms, followed by Wipro, TCS and HCL Tech. Among mid-tier firms, Mindtree is likely to be the top performer with a 5.5% sequential revenue growth, followed by L&T Technology Services, LTI and Mphasis. Meanwhile, on the bourses, the Nifty IT index is down 28% for the year, while the Nifty index is nearly flat. The correction has largely been due to the derating of valuation multiples, experts believe, but they do not see more downside potential for the same. According to HSBC Global, valuations now look reasonable, broadly in line with 5-year averages and the market. So unless key markets like US and Europe suffer prolonged recessions, dragging Indian IT growth to mid to low single digits, the valuation downside risk looks limited. Hence, we expect IT stocks to compound with earnings. The US monthly jobs data is likely to sway market mood today, as the street will track global cues along with rupee levels against the dollar.
Winter is likely to be more challenging for IT firms as the falling global demand may have a bearing on their earnings. Meanwhile, the weather may not be pleasant for Delhi and NCR residents either. Chill spells misery for them. Farm fires dot the region, turning the air foul. Last week, as the air pollution soared, authorities had to impose the Graded Response Action Plan or GRAP to deal with it. Our next report tells more about it.
According to a recent report, 18 of the 20 cities with the most severe increase in fine particle pollutants called PM2.5 between 2010 and 2019 were in India. And out of them, Delhi has earned the distinction of being the most polluted city of the world. Reports also say that the lifespan of people in Delhi can shorten by up to 10 years due to air pollution. And the winter is worse. Farmers across the northern plains start putting the stubble on fire after harvesting the crop. Successive government schemes to lure them away from stubble burning have failed. So, as a last resort, the authorities impose Graded Response Action Plan or GRAP to bring down the pollution. It is an emergency response mechanism which is only enforced when air pollution reaches a certain threshold. Formulated in 2017 by the Environmental Pollution Prevention and Control Authority and the Delhi government, it is a step-by-step plan to improve Delhi NCR's deteriorating air quality. GRAP classifies the presence of particulate matter PM2.5 at 61 to 120 micrograms per cubic meter or PM10 at 101 to 350 micrograms per cubic meter under moderate to poor air quality. When enforced, this category of GRAP measures includes heavy fines on garbage burning, closure of brick kilns, or strict enforcement of pollution control regulations in such kilns, mechanized sweeping and water sprinkling on roads with heavy traffic, and a strict ban on firecrackers. If the concentration for particulate matter reaches 121 to 250 micrograms per cubic meter for PM2.5 or 351 to 430 micrograms per cubic meter for PM10, the GRAP classification is raised to very poor. Under this classification, the use of diesel generator sets is prohibited. Parking fees are quadrupled, bus and metro services are increased, people are discouraged from lighting fires, and the government provides electric heaters. People with respiratory and cardiac conditions are advised to restrict their outdoor movement. GRAP measures for severe air pollution are enforced when PM2.5 levels cross 250 micrograms per cubic meter or PM10 crosses 430 micrograms per cubic meter. In such a situation, brick kilns, hot mix plants, and stone crushers are closed. Power generation from natural gas is ramped up, people are encouraged to use public transport, and the mechanized cleaning and sprinkling of water on roads are carried out more frequently. When PM2.5 concentrations shoot over 300 micrograms per cubic meter or PM10 levels are above 500 micrograms per cubic meter for more than 48 hours, GRAP measures for the severe plus or emergency classification will be enforced. Heavy vehicles like trucks are stopped from entering Delhi. Only those with essential commodities are allowed. Construction work is suspended. Government takes a call on implementing the odd-even scheme for private vehicles. The government also sets up a task force to decide on any additional steps, including shutting down schools, colleges, etc.
I will achieve Backed by the nation's trusted bank, SBI, the banker to every Indian.
The GRAP requires action and coordination among 13 different agencies from Delhi, Uttar Pradesh, Haryana, and Rajasthan, including the respective state governments, state pollution boards, traffic police, Central Public Works Department, and Petroleum and Explosive Safety Organizations or PESOs from each state. That's all for today. For more news and analysis, log on to businessstandard.com. We'll be back tomorrow with our next episode. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.